Hi, I'm Rick Kaler. Thanks for joining me. If I asked you how much risk that you're taking with the investments in your retirement plan, what would you say? My guess is 9 out of 10 people couldn't answer that question in a meaningful way. Answers like a lot, or just right, or not much, may as well be saying, I have no clue. We typically think of risk levels in terms of risk tolerance. This is the appropriate portfolio risk that a person would be most comfortable taking with their investments. While investment advisors are required to assess your risk tolerance, and you can measure it yourself on a number of various internet sites, determining what risk you're comfortable with is more of an art than a real science. It depends on the investment return that you need to produce an acceptable retirement income and the asset allocation that's going to give you that return. It's also a very delicate balance between emotions and financial reality. For example, when markets are rising, everyone's comfortable with their risk tolerance. I have known retirees who had their entire retirement portfolio in a handful of small company growth stocks. Now that's a powder keg of investment risk by any definition of risk. Yet, they were entirely comfortable with that risk because the stocks they were in always went up. Anyone with a stock that always goes up either hasn't held the stock during a bear market or only looks at their brokerage statements, say once every 5 years. To find out what comfort really means when it comes to risk tolerance, it helps to define uncomfortable. While risk tolerance tests will ask you how far must your portfolio drop before you freak out and sell, the best way to find this out is when markets are in a free fall. If you stay in the markets long enough to see them turn around and rise again, your risk tolerance was probably comfortable. But if you sell out, it's a pretty good indication your risk tolerance was not as great as you or your advisor thought. Unfortunately, selling out at a market bottom is a very costly way to find out the risk you had in your portfolio was uncomfortable. I can think of one person that had about $1.5 million back in '08 that sold out at the bottom in '09, and that cost them $400,000 that they will never see again. If you've been investing for over 10 years, finding your risk tolerance is pretty simple. Like I said, think back to 2008, 2009. Did you stay in the markets or get out? If you got out, your risk tolerance was much lower than you thought it was. Look at old statements and find out what percentage of your investment was in equities, that's owning things, and what percent was in fixed income investments, that's loaning money through CDs, money market, and bonds. Express this then as a fraction with your equity percentage first and your bond percentage last. So if you were 66% in equities and 34% in fixed income, your asset allocation was 66-34. So the first number always represents your equity position. So if you stayed in the markets, go back to 2008, if you stayed in the markets, your allocation was probably comfortable. If you got out, it certainly was uncomfortable. So if your allocation was 70-30 and you stayed in the market, maintaining that allocation should serve you well. Maybe you could even increase the equity portion to 75-25 or 80-20 and still be comfortable. Conversely, if your allocation back then was 70-30 and you sold out or reduced the percentage you held in equities, your allocation clearly offered an uncomfortably high level of risk. you will need to reduce the equities in your portfolio. This is especially true if you got back into your old allocation or something even riskier to make up time. So if you were 70-30, you got out, then you panicked a few years later and got back in it in 80-20 or 90-10, you're setting yourself up for doing it all over again. You probably are taking too much risk and really need to take a hard look at that. And I would argue reduce it right now while the markets are good. What I'd suggest is really reassess your risk tolerances if you are a new investor. So in my next video column, I'll suggest some ways that you can do this. Thanks for joining me.